Good afternoon and welcome to the Market Wrap for APW for the 29th of October 2021. Stuart Williamson here at the helm. This week we're going to be talking about a variety of interest rate issues, inheritance tax, and what the state of the current residential market is. So off we go. Okay, UK interest rates to rise on November the 4th. That's the question, will they or won't they? Consumer confidence is at its lowest level since the first lockdown in the UK, amid rising cases of COVID-19, soaring energy bills, and deepening concerns about the UK's economic outlook. Frankly, I would have thought that it's a pretty grim time to be increasing interest rates until we're probably out of the woods when it comes from an economic perspective. So we had a look at the FT last week to see what their comments were, this week rather, to see what their views were. And their comments are basically the UK's economic rebound has hit strong headwinds in October, and consumer confidence has dropped to the lowest level since the last lockdown, and record share of manufacturers reporting material and labour shortages. Basically, it all went very well, but the October data is looking pretty grim. The monthly consumer confidence index published by GfK dropped 4 points to minus 17% in October, which is down 10 points from the pandemic high point in July. And it's as low as the lowest score we had right at the very beginning. Joe Staton, who's client strategy director at GfK, said that after a robust recovery in the first half of 2021, UK consumer confidence has taken a turn for the worst, amidst fuel and food shortages, surging inflation, squeezing household budgets, and the climbing COVID rates. So it's pretty grim. And it's important to watch this index because it basically is one of the biggest parts of the recovery. I mean, basically 4.1% of the economic growth for the year to date has been supplied by UK housing spending. Of the 4.8% has actually occurred. So it's the largest driver of the rebound. Declining confidence comes as the manufacturing sector is also facing a lot of headwinds. You know, it goes back to, I remember the Evergreen getting stuck in the Suez Canal. You know, that has had a major effect, if you can believe that, on logistical deliveries. According to a separate survey from the CBI this week, almost 2/3 of manufacturers cited availability of materials and components as a factor likely to limit output in the next quarter, which is the highest proportion since January 1975. Anna Leach, a CBI Deputy Chief Economist, said, from higher material costs to labour shortages, manufacturers continue to face a number of serious global supply challenges, hampering their ability to meet strong demand. So therefore, to me, it would seem crazy to increase rates, but the markets don't think so. The FT quotes the Bank of England chief economist warning that UK inflation is likely to hit 5% very shortly. That guy's name is Hugh Pill, cracking name. On the back of that, gauges of future prices put the odds of a rate change at November's meeting next week at the 4th of the MPC at 80%. Governor Andrew Bailey's statements that officials would need to act to curb inflation set the hairs running over the weekend. Despite news that inflation actually fell in September to 3.1%, they think it could go back up to 5%. Now, swap rates, which are a good barometer of the path of borrowing costs, are currently climbing sharply. Spreads between 2 and 5 year fixed rate mortgages at 75% loan to value and their respective rates in the swaps market are now approaching 0. Okay, so I don't really understand how swap rates work, but basically it means that interest rates are going to go up. And now what does that mean to you? As you said in the last market wrap, an increase, as they suggest, of 3 interest rates changes by the end of next year would increase your repayments to £180 more on a £200,000 mortgage. But put it into context, if inflation is running at, say, an average of 3% in 3 years, that increase would have been wiped away by inflation. So I don't think in the bigger picture it is that big, but you need to be aware that interest rates are likely to go up next week. Secondly, there was a budget yesterday and we had some rather pleasant news from the Chancellor that he's knocking 3 pence off a pint of beer, which is great, obviously. But one of the things that he did do by stealth tax, as they call it, is that he froze the inheritance tax level for another 5 years. Now that's important because more and more people are falling into that. Apparently the same by the Office of Budget Responsibility say that 50,000 people will fall into that by 2026. up from 22,000 in 2018, and only 6 months ago they were saying 36,000. So what does it mean? Well, what is an inheritance tax for a start? It came first introduced in 1694 as the Stamps Act, and it was applied to estates worth more than £20, and it was to fund the War of the League of Augsburg, which I have no idea what that's all about either. And basically what it is that over £325,000 you pay 40% tax if that's going outside of a marriage. Between spouses there's no inheritance tax. Unless it's a non-domiciled spouse, then there is. So £325. On top of that, you've got potentially an extra £175,000, which is called the main residence nil rate band. So perhaps you've got £500,000 that you can pass on. And then you pay 40% tax over that. And with that average house price getting close to that, 300,000 quid, it's becoming a bigger threat to wealth. And so consequently, if you can buy through a special purpose vehicle, which we talk a lot about, it's well worth considering that as a way of planning for inheritance tax provision. Okay, why is it a stealth tax? Because I tried to do some research on this, and I don't think it's increased since 2010. So it's been £325,000 according to this freeze for nearly 16 years. And if we've got inflation just at 2.5%, over 16 years, that's 40%. Okay, so it means that basically that 325,000 has actually declined by 40% in real purchasing power during that period. And it is the reason why so many more people are getting caught by it. So something to be aware of. SPVs might be a good idea, a good way to go. Finally, the Zoopla House Price Report was out on the 26th of October, and very quickly they say 2020 was a record year for sales, with house sales exceeding the highs of 2007, where 1.5 million occurred, and over 473 billion of new sales agreed, the highest ever. There's no sign of any cliff edge. The impact of the pandemic on activity has further to run, albeit at a less frenetic pace. They say there's further room for average house price growth, because in most affordable housing markets where a current rate of growth is still high. The primary headwinds of 2022 will be higher living costs, which is inflation, and increased mortgage rates, which will affect buying power, which of these increases are discussed. House price growth will be greatest in the North West and the East Midlands at 4%, and lowest in London at 2%. What does that mean to you? Not a crash. The boom's going to slow. There's still good upside, and it's still a good buying opportunity. Finally, just a note on e-commerce. We talk about East Midlands being a great place to buy because of this e-commerce growth. House prices are going up well. Rents are up by 9%. There's lots of customer satisfaction hubs being built there. And what they have a hub and spoke approach, these distribution companies. Hubs are the big ones. Then you have spokes reaching out to urban areas where they then distribute from, and you can get them in the same day, basically. I think I bought something off Apple last week, and it was delivered the same day. So those hubs lead to spokes, and spokes are in urban areas, which are taking up areas that would otherwise be used potentially for more housing developments. So that's going to exacerbate the urban problems. So it's going to get worse, frankly, the housing shortage. Now, if you look at the latest data as who has got the largest amount of e-commerce going on in the world, the average is 6.29% growth in e-commerce. The UK's growth in e-commerce is 3.47% over the next 5 years. I mean, that's compared to places like Turkey, where it's 15% growth. So the UK's growth is very slow, and so it will accelerate, and we will have more of this e-commerce, and it will have an impact on where is a good place to buy. So there we go. That's it for this week. Overall, the outlook is positive. Interest rates will increase, but not at such a level as to drive us into a crash, because they've got to balance it out against what's going on in the UK economy. Thanks very much. Bye-bye.